Thank you very much, Catherine. It's our pleasure to be here. As Catherine noted, one of the things that we do at Quasar Distributors is work with all kinds of mutual funds, from the startup phase into what I would call very mature. Quasar has been around for approximately 19 years, and so we've seen through a variety of market cycles, funds mature at varying paces, and really the fund groups represented today by Jennifer and Devon, I think as Catherine noted, really are going to help illustrate how there are varying ways to do this. People are often in search of what you might call a silver bullet. If we love talking about how there is no silver bullet, there are a lot of ways to succeed and fail, sometimes deploying the very same strategies. And so I think the objective or the goal here is to try to elicit, talk about, identify things that have worked, perhaps things that may not have worked during each respective firm's course of time here. Akre over getting close to 10 years as a fund group, and certainly Tortoise, I think we're getting close to 8 years.
Funds, yeah.
Thereabouts, at least on the open-end fund side. But having said that, I'd like to start, at least at the outset, just introducing our panelists. And so Jennifer, we'll start with you to tell us a little bit about yourself and Tortoise.
Sure. Thanks for having me. Jen Ashlock. I've been with Tortoise for just over 5 years, and prior to that, I was with the New York Stock Exchange and Morgan Stanley and Van Kampen, when there was a Van Kampen, with all the consolidation. And so, like I said, I've been with Tortoise for about 5 years. We've seen a ton of growth, as Andrew mentioned, over those 5 years. Not only in AUM, but in our products and our product structure, and even our name. We really don't even go by Tortoise Capital Advisors anymore. I have to say it's just Tortoise because we have so many different advisors under our umbrella. But we've grown to about 180 employees, and I think when I started, we were at about 50, and we had just an office in Kansas City, and now we have Kansas City, LA, New York, and London. So, grown a ton.
Devon, how was your drive?
It was wonderful. I left Purcellville, Virginia, which is where I live. It's about an hour west of here at 4:30 or so, and just thought I would spend a little time in D.C. It's one of the only times it's quiet down here, so overshot that a little bit. So I represent Akre Capital Management. We are 12 people located in Middleburg, Virginia. If you're not familiar with the area, just go down 66 west till you get to 50, and then drive until you get to a town with one traffic light, and that's where we are located. In that humble town, our firm has been very fortunate to manage a little over $11 billion currently. Our existing 40 Act mutual fund goes back to Andrew's point, almost 10 years. It'll be 10 years September 1st of this year. But our firm's been around for 30 years. So we have separately managed account assets. It's about $560 million, and that goes back to 1989. And we also have a Reg D offering, so it's not really a hedge fund, but categorically folks call it that, partnership, and that goes back to 93. I joined Akre Capital in March of 2012. At the time, there were a few $100 million in the fund. It had been open about 2.5 years. About half the assets in it at that time were actually clients that had been with us for a very long time. We had the unique situation where our founder had been the portfolio manager by way of a sub-advisory relationship at a former fund, which certainly creates an opportunity as it relates to trying to generate some buzz when you're going your own direction. It also poses challenges, but I've been in distribution since 2005. I actually started working in the wirehouse channel with Columbia Management, now Threadneedle. I'd worked for some ETF firms and even spent some time on the retail side. Obviously that didn't work out. That's why I'm back where I am. But all the experiences were helpful given the fact that for marketing, we're pretty much a one-person shop.
In the course of this discussion, I will want to come back to those experiences. Sure. Because I think one thing that we observe in our role at Quasar is seeing how the experiences that our clients have in their prior lives can certainly help them in this current environment. I may be the exception as a prosecutor that never comes in handy prior to doing what I do today, but it does become self-evident to me at least that those experiences are an important part of some of the evolution, some of the decisions that are made, whether it's by Akre or Tortoise. So we will get back to that. I want to start with how each of your firms launched. Many in the room are familiar with the multiple series trust structure. Both Tortoise and Akre have come to market, so to speak, within that structure. And Devon, I know you weren't physically present at the time, but the way in which Akre launched was rather fascinating to me. We were told, as an entire service provider, hurry up. This fund has to come to market quickly. And again, knowing that you weren't there physically, let's talk about that a little bit. My recollection, this is getting close to 10 years ago, when this fund launched in, say, fall of '09, is that right? Fall of '09? That's about right. $200 million flew into this fund rather quickly, but then it sort of got really quiet for a while. Let's talk about that a little bit.
Right. I think, so first of all, for a fund to launch and immediately be available at Schwab and Fidelity and TD, and having no prior experience in this, it took a while for me to appreciate how rare that is. If any of you have launched a new fund, maybe your firms or a client of yours had a separate account track record and is now going the 40 Act route, that's really difficult. I don't know how long it takes, but most firms want you to have some kind of a track record. So that is a benefit. But as I had stated, and I didn't know this until a couple of years ago, about 150 million of the capital that came over were separately managed account clients of ours that essentially were gracious enough to seed the mutual fund. The reason for the speed is when you're leaving another track record, which for compliance reasons you might be aware you cannot market, you can't even speak to, not even in an email. That came as a bit of a surprise to one of the members of our firm who's no longer there. The assumption was we'd be able to utilize that. But the other assumption was, well, folks are going to follow the manager. And usually that is true. But there's always reasons not to invest if you're not familiar. When you're very much at the point of sale, as I spend most of my time, you realize that folks are trying to make decisions based on what their clients are going to hold them accountable to. So following the manager and an old track record sounds great, but you've got embedded cap gain. There's a number of reasons not to necessarily make the move. So in our case, although on its face it is a success, and we got past what is previously known as that break-even amount, that $100 million special AUM level, was certainly extremely helpful. We were very unique in both respects. Ease of launch, albeit with U.S. Bank's excellent help, they did get it done. To my knowledge, they still use this as a case study of the fastest onboarding, and they should, because that's no small task. I should say we value their partnership very much for more reasons than that. So between that and then having definitely some folks that are very willing to follow the manager was helpful. So we were off to a strong start, but as you said, it sort of died off, the activity, and I think the founder of our firm, as well as the former manager that I'm speaking of, assumed that most of the assets would port right over, and that's just not the case. Particularly when my founder and the portfolio manager, he walked away from the portfolio at age 67. It was over $1 billion in assets, and he launched the new fund with 10 grand of his own money. Now that's the makings of a great success story, but it was sort of to be determined. So I think it took a couple of years for folks that were thinking, do I stay, do I go? The existing team on the former fund continued to do well and continues to do well today. And so, there are a number of clients that have stayed with that fund the entire time, and that makes perfect sense. So the goal for us was really to sort of start over, and that's sort of the approach we took.
And we'll get into some of those growth spurts, but Jen, I want you to come along and start by kind of talking about the product structure, how Tortoise got into the open-end mutual fund space. We know the advisor's history predates the funds by some period of time, but what's gotten into the philosophy of the product structure at Tortoise?
Yeah, and similar to what Devon was just mentioning, we started out with separately managed accounts, as many do, and we had an interim step there with the closed-end funds, and I think that's one of the big distinctions. And what we really look at, not only product structure, but access. So we actually launched, so we have previously been in not only the energy space, but specifically MLPs for anybody who's not familiar with Tortoise. So a pretty small niche spot. And in the separately managed account business, you have the intricacies of all the K1s. So Tortoise actually came up with the first registered MLP closed-end fund, which alleviated that hassle and had a 1099. So that was, I think, a game changer for Tortoise. It gave us a bit more credibility in that space of allowing access to more retail investors that really can't handle the complications tax-wise. So that was, I think, a great middle step between the SMA business and the mutual fund business. That was a little bit of a distinction. But then doing the open-end fund, I think the biggest difference and the challenge for Tortoise was we really think about structure a lot, and we look to where we think there are voids in the market. So the MLP business and the closed-end funds were pure MLP products, and we just don't believe that pure MLPs is the best structure for an open-end fund. So it's really a more broad pipeline fund, which the interesting part is we were really preaching this, and I remind our salespeople this all the time when they're out talking. We were talking about this 6-7 years ago when we launched the fund, that it's important not to be tied to not only a product structure, but the structure of a company, that an MLP is really just a structure of a company. We like the underlying assets. And, people listened, and we've raised $2 billion pretty quickly, actually. But if you're at all involved in the energy space, you see now with all the consolidation that we actually, it was a pretty nice call, and some of our competitors that do have strict MLP funds are in a bit of a bind right now when they get acquired by their general partner, and their structure actually doesn't work as well. So as Andrew said, we had a lot of foresight into that, and I think it was actually a challenge for the first several years to talk about you don't have the yield. So there are some things that go against that structure, but we believe so strongly in the structure that we chose that I think it's really kind of played out in our advantage. And then after the open-end fund, we decided to go the passive route for ETFs for much the same reason, and we want all investors to have access to the strategy that we think is very important to their portfolio, but also in that space, even more significantly, most of the assets were in pure MLP play funds. So it's really about getting access to all investors in the structure that we think is the most beneficial.
We talked about, or Warren talked about this quite a bit yesterday, the importance of product and product structure. The ETF question, this comes up a lot. You establish a mutual fund, it's successful, or maybe it's not, or maybe it's okay. Tell us a little bit about how did Tortoise decide, let's get into the ETF space? It's not a natural progression, but it's definitely something we see a lot more. Mm-hmm. How did Tortoise get there?
Yeah, and that's interesting. As you might expect, it was a split decision. From a business decision, a great decision. The portfolio managers maybe not quite as much, because there's always that fear of cannibalizing your active business when you go the passive route. However, we do have one thing that's a little bit different in that we have our own indices, and we create those indices. Our kind of tagline for our passive business is actively research indices, passively managed products. So we really do a lot of research when we create our indices in much the same way that we do our products. We don't have any really Me Too type indices. We look for voids in the market, again, asset classes or subsets of asset classes that we don't think have a natural benchmark. So when getting into the ETF business, we still really we build those indices with the best active research that we have. So again, you're getting that kind of superior structure in our opinion, but in a passive wrapper, if you will.
And you made a reference, you said the word sales team. Mm-hmm. And we'll get to Devon's Army of One later.
Right here.
For better or for worse.
How has that played? And again, as Catherine was noting, your approach, Tortoise's approach, very, very different from the way Devon operates from a marketing and growth. How does that sales team, talk about, I guess, first off, the structure, what sort of boots on the ground does Tortoise employ, and how does, their role come into play with respect to the product structure?
Sure. As with everything with Tortoise, that has evolved a lot over the past several years as well. We had a previous majority owner that was Mariner, and they actually had a sales team that covered Tortoise along with the other fund families in their family, which is likely why we were in the Series Trust to start with, because it made a lot of sense. But we found that they were actually spending so much of their time on the Tortoise products that we brought them in-house almost 3 years ago. So we have a distribution team of about 10 RVPs out in the field, and then we have a desk in the Kansas City area. And we also have a pretty robust national accounts team working with home offices and on the platform. So I would say where they really come into play in the structure is we really come up with what we think is the best idea from the asset class perspective, and then we look at wrapper second. So, if we come up with the type of fund that we want to create, if we want to go more for the RIA crowd, then we might look, and we just did an interval fund a couple of years ago, and we just finished actually a roadshow for a closed-end fund, which we hadn't done in a really long time, really focusing on those wirehouse firms. So we really look to our national accounts team and our distribution team to let us know where that demand is. So where's the demand for the asset class, and then what wrapper makes sense for the audience that we're going for.
From a background perspective, Tortoise does operate 3 share classes. You have your classic A share, front-end sales load, a C share, which I'll just editorial comment, C shares continue to shrink. Dave, I can't wait to talk with you about that client of yours. Dave had a client that came to market with a C share recently. It's like Haley's Comet. It's amazing that it's still there. But then predominantly the institutional share class, or as Doug Hansen says, the 12B1 less share class, probably speaks to the majority of the assets within the products. Devon, your army of one, as I called it, Akre with a no-load share class and institutional as well. Your approach to the marketplace and how you come out. Let's talk about that a little bit, on how just given the infrastructure and the resources that you have, how your sales process may differ significantly, I guess, from Tortoise.
Well, the first sale for me really had to do with Chuck Akre, our founder. If you're not familiar, investors and marketers don't always share equal levels of regard. So though I think portfolio managers are some of the brightest folks out there, they don't necessarily think marketing folks are. And that's okay. Sometimes, and probably all too often, that might be true. But the reality was we need to be on the same page. Fortunately for me, there have been a couple predecessors, so to say he was sort of broken in that respect. You start hearing the same thing from 3 or 4 people after a while, regardless of skill or ability. You start to think, okay, maybe there is something there. So that's a wonderful position to be in. We have, at this time when I arrived, about 2.5 years of track record. And 2011 was a very good year, which I think is almost solely responsible for the sudden uptick in flows. They doubled the fund's assets in 60 days. So I think folks that were sitting on the sidelines waiting to see if our founder still had it sort of kind of made up their minds, and I showed up at the perfect time. That said, I asked Chuck at the outset, what is it we're looking for? We can't be all things to all people. That's just a reality. If you want to build a big sales team, we can do that, but is that the goal? I mean, how do you grow? Some are very good at the acquisition model. Mr. Hennessy is a classic example of that. We're not that firm. Others work for a large distribution unit when want to acquire boutique firms. We didn't want to be acquired. So it really came down to know who you are, know what you're not, and then market from a place of genuine sort of identity. And he said, I don't want people looking at the exit sign on the way in. Well, said every portfolio manager ever, right? So at the end of the day, I'm thinking, okay, so we're trying to avoid hot money, so we don't. That's great. We can't afford hot money actually, because what that requires, in my mind, is doing the classic wirehouse tour, spending a lot of time. DC and Virginia used to be my territory when I worked at Columbia Management, and I had to see 80-90% of those people every 6 weeks. That most of you are familiar with that model. The RA model is much different, and the reality was I had transitioned RIA to the RA market in the midst of the financial crisis. So folks that are usually sort of standoffish wanting to talk to me because I represented a certain ETF firm who was in the news a lot at that time. So having lots of difficult conversations was like jumping in the deep end of this culture shock that, RIA versus broker-dealer. So what that gave me was a real interesting view. And wow, these folks are fiduciaries. Like they're really on the hook for results. That's much different. So I just started from scratch with RA database. Now we own Discovery, or subscribe to Discovery, and read ADVs. I think last count I'd read like 6,000 of them. They're really not much fun. But the reality is, I just, when you only have a few $100 million, nobody wants to give you $30-40 million. Nobody wants to be a 10% client. So I decided to focus on RAs and family offices under 400 million. 250 was a sweet spot, looking for 2s and 5s, and just sort of pebble, brick, stone, and hopefully one day boulder. And we've been fortunate to have that approach. At Current, we did cross $10 billion just recently in the fund, and 95% of that is, or I should say 65% of the assets are advised. Only 5% are wirehouse, so we have very little. About 80% of those funds are right here in DC and Virginia, my former stomping ground, so that kind of works out well. So you kind of do everything, is to answer your question on the big picture. Jen and I were talking about conferences, Morningstar, Schwab, and so forth, and they're also lots of fun and expensive. But when you're a young fund, by perception or reality, you have to do those things along with a lot of other stuff. So you kind of figure out what works by the process of elimination, a lot of work.
So given the importance of the RA community and family office, when I hear those words, I think supermarkets. I say this a lot to people. I kind of mock the old talk to Chuck slogan. Well, no one talks to Chuck. You're talking to an RIA, which has to park their money somewhere. That's why Schwab is so important. That's why Fidelity is so important. Do you then, I suppose, and this is quite leading, spend an outsized portion, whether it be the events that those two organizations, or the event that Schwab throws with Impact, how critical and important are venues and places, conferences like that, given you don't have an army at your disposal?
Yeah, I mean, you play the cards you have, right? And so I don't know if this is the direction you're going, but Schwab itself has many events and obviously lots of branches, and the regional managers are sort of, in part, the gatekeepers to access. And so I would liken that to the independent broker-dealer channel, in a sense, where you've got these smaller concentrations of capital, and there's a little more of them. But to sort of get in, you've really got to schmooze with it. You've got to do the golf tournaments and things like that. I'm horrific at golf, so that was out. But it also comes down to where we're going to spend time. My goal was to get in front of decision makers as soon as possible. The nice thing about a $250 million RIA is he's not getting nearly as much, I call it heat, but as much marketing being blasted at him as a billion-dollar shop. That's changed a lot. Some of my first clients, all $300 million RIAs used to get a dozen calls a week. Now it's over 60. And if you're a billion-dollar shop, it's north of 100. White papers and constant contact and ways to market in a very pretty fashion. But at the end of the day, they're tuning out because they have jobs. So that makes it more and more challenging to get in front of folks for everybody in my position, whether you're in a management position, a distribution, or you're actually in sales. So fortunately, it's now and not then. It would be even more challenging now. Most of the people I speak to have never heard of us. It's the fun part of a boutique is explaining that you're actually a real shop and you have a roof and all those things. So
I regularly have to correct people when they try to pronounce your fund name.
Yeah, I get Green
Still
Acre
happens.
Funds. I've heard it all.
Yeah, with a guy's name like Strnad, I can relate to the problem. Jen, from the CMO perspective, you guys engage and interface with a lot of different channels, just as evidenced by the sales structure. But from that CMO role, how do you begin thinking about collateral material and just all the material? I mean, you guys are prolific. Your website is quite robust from our client base standpoint. Tell us how that began and how that evolves today.
Yeah, and it continues to evolve, as I said, with everything. And when I started 5 years ago, we had always done a lot of thought leadership because I think we have really, really smart people that people really look to figure out what's going on in the specific markets. So, but we've done a lot more, and it started, I think, a lot with media, actually, which is a little surprising. But it wasn't long after I started it. I'm not to blame, I swear, but the energy market downturn started. I only had the sweet spot for about six months maybe, but nobody was talking at that point. So we were kind of one of the few voices out there. We really leaned in, and we would go on CNBC when oil prices were hitting record lows, and that really kind of established us as a thought leader in the space. So I think that helped to kind of kickstart things. And then we really branched out into a bunch of different mediums. So we still do a lot of media. We do weekly podcasts, and that actually will kickstart some media discussions, but it's also something that our investors have really come to depend on, so much so that we also have quarterly calls that we've seen our attendance actually drop fairly significantly, or at least the number of questions, because they tell us that they're getting what they need on a weekly basis. So, I think that timely nature of information, especially in a down market, is really important. And those are things that we do on a broad scale. But then I know you were talking about the different types of clients. And we can tend to blast those messages more to the RIA community, but then we have a lot of our assets actually in the wirehouse firms, not only starting with the closed-end funds, but then getting on the platforms with the open-end fund as well. And that's a lot more of a challenge, because you really can't do any sort of blast email, so it's a lot more targeted, a lot more one-on-one. And I think we depend a lot there on our national accounts team and home office research, and really tying into what they're telling their advisors. And when we have something that's relevant that we can tie into from a thematic standpoint, we really use push our thought leadership in that direction. So it's really customizing and tailoring for the different audiences, not only in content, but in the medium that we use as well.
Well, certainly, I don't want to inhibit questions. So as we proceed, raise hand, draw my attention. We'll get the microphone, I trust. Thank you. One thing, being at Quasar, half of our headcount is really devoted to compliance. We're probably one of FINRA's largest customers, just in terms of the amount of marketing materials that are submitted for review and comment. So we can't go an hour, despite this being a distribution marketing focus. We got to have a little compliance discussion. How do you guys manage that? I know that that's a very broad 50,000-foot question, but compliance is a reality. You mentioned the fund in the public domain. You are subject to FINRA rules at that point. Talk about that balance. We hear a lot of, or at least I hear complaining in the background of, Quasar says no, we can't say these things. FINRA said this. How do you administer that and handle that? Jen, we'll start with you, just given, again, the volume of material that we see.
Sure. We have a really delicate job in marketing, I think, balancing what the distribution team and the sales team wants to say with, yes, compliance, and making everything obviously compliant but compelling. So we've had a great partner with Quasar, and we really apply everything that we hear back from Quasar for all of our products. So that's another challenge as well. Not all of our products go to FINRA because we have closed-end funds. We do a lot of advisor-level thought leadership. So we really try to have in the back of our mind everything that we do is compliant and really consistent with our open-end funds and ETF materials. But it is delicate, and I think we talked about this a little bit a couple of weeks ago. We like to be the team that when distribution says compliance, or Quasar or FINRA says no on something, we can change that enough that you won't even notice it. We can make it compliant, and that's my job, to make sure that we are getting the message across, getting clients what they need, but making sure, of course, more than anything, one compliance burn can really crush your funds and your firm. So it's a tough job.
Does this provide? It almost sounds like you want to provide an opportunity to educate people internally. You may not need to be the compliance expert, but you got to understand it.
Right.
I think that probably goes to the balance. We observe that quite a bit. Our clients want to know, how can we apply this, as opposed to being reactive and perhaps being explosive about it. Not very productive, I would say. Devon, compliance, within your walls. Obviously, a smaller group. You probably wear a lot of hats. In fact, I know you do. Yeah. How is that ingrained, within your culture, and how you guys produce a message?
It's different today than it was when I got there. Some of the folks that work for Chuck, our founder, they were like, "Oh, he's the mutual fund guy. Here, take this folder and take this folder." And I'm like, "Okay, well, where's all of our marketing collateral? I've seen the fact sheet." They're like, "Yeah, that's it." And I said, okay, do we have a commentary? They're like, well, we did one once, but let me see. Okay, yeah, we have this, and it's like 2 paragraphs. And I'm like, all right, so who writes this? Like, who's in charge? They're like, well, now you. And so I'm like, okay, well, how long does this take? And about an hour later, I'm just staring, into the abyss going, oh my, what have I done? So I made a call to U.S. Bank and just said, listen, I have absolutely no clue where to start. How far ahead do I need to get this stuff to you before I can get a fact sheet on time so I can go on the road and do my job? And so it took a while between that and wrestling with, look what we did. Let's talk about this investment idea that worked out well. And I'm like, no, you can't say that. That's promissory. I'm like, but the numbers are right there. So for me, it really came down to like understanding, the whys behind the whats. It's not a culture of no. It's a culture of let's reduce this compliance liability to 0. We can do it. But from a marketing person's perspective, it can be difficult. So basically, we should have hired Jen because she apparently makes that job much easier for her sales team. So, lesson learned. But it is really important because you can spend a lot of time on it, more time than you need. So we're not big on content. We don't have capital markets calls, so that's a huge portion of things. We're not pumping out white papers. Our turnover is very low. So even though we have quarterly materials, and they're the basics for all of you not aware, you absolutely need the fact sheet, commentary, pitch book at a minimum. And then supporting documents. A lot of funds will provide full holdings, sometimes by prior month, let alone prior quarter. We don't do that. We do a 60-day lag, which frustrates folks because we can't get them attribution, which is another thing. If you're truly an active manager, they're going to want to see. We don't provide that. But once you sort of figure out whatever works again for your suite, then you've just got to have things on the calendar so that you're not delayed. Because if it takes you 6 weeks to get a fact sheet, you're constantly catching up, and that inhibits sales. So leveraging a strategic partner like Quasar and U.S. Bank is pretty key.
Access, because this sort of segues into access to PMs, making personnel available either to the media or to anyone, frankly. How does that begin, I guess, at Tortoise, an organization with a lot of different products, a lot of different strategies? We observe this, I guess, from a great distance at Quasar, but is there a process by which marketing gets involved in that, and how does that work at Tortoise?
Yeah, and this was that shift that I was talking about at the beginning. We had a pure mindset change not long after I joined, where originally the portfolio team entirely, they had zero desire to do media, didn't really want the portfolio managers. Talking to clients was great, but doing anything marketing-wise, writing materials, was not considered a good use of their time. And again, I think it was really during that downturn when we were able to plead with them to please change their mind on that and get out and talk more. And that it's been interesting. We started off with us doing much more of the legwork, and when we would we actually hired a PR team to help us with that endeavor, and they would secure something great for us, and we would take so long to get back and say, yeah, we'll do that television interview, and say, thanks, it aired like yesterday. So if you don't move fast, it's not really helpful. So we've gotten much more proactive, and as I mentioned, doing the podcasts, and we send those transcripts out to the media. And sometimes we'll get a quote where we never even spoke to anybody. They just purely take quotes from some of our content. And I would say we're probably in Bloomberg or Reuters at least once a week, and we get a television spot maybe at least once a month. And it's grown, though. It's been a lot of hard work, and it takes showing up quickly and having a lot of enthusiasm and knowing how to work with the media. But it's been, like I said, it's actually translated to investors seeing us in the media and taking that as themselves getting information. So it's really helped a lot.
And you revealed to me, don't keep it a secret, what did you guys just launch in your offices? You have a studio now?
We do. We're starting to get so much traction that we built a studio in our Kansas City office so that our portfolio managers wouldn't have to either drive downtown or go to New York every time we wanted to get a media interview. And that's actually increased our exposure by a ton, because especially in the energy markets, if something is happening kind of crazy that day, they really want you on air within an hour or so. So it's really helped, and it's again turned us into, I think, that timely subject matter expert that's been very helpful.
Do you yourself or who sort of is the liaison, if you will, to the media and to the public? Again, something else we get to observe from a distance is, I don't know if it's a crowd control sort of a thing, but is that something that just happens within your walls, or do you guys actively try to manage, I guess, the media appearances, whether they're TV, radio, or print?
Yeah, we did hire a firm, and that was the big thing. We hired an outside firm that's based in New York, and that's helped a lot. It also helps when we're doing any sort of launch or acquisition to have that outside firm kind of funnel things through and vet opportunities for us. And early on, I think we were still doing some paid appearances, paid media, and those things really you need to vet pretty strictly to make sure that they're worth your time and money. And now it's the exact opposite. Now we're wondering if it's worth the time of our portfolio managers. And so we have the media, the PR firm letting us know this is a great use of their time. And we really try not to waste. There's still that mentality of, they'll give us the access, but don't waste their time. And then once we do have content from a portfolio manager, we try to push it out in any type of medium that we can, including blogs, any way that we can just get to as many people in the way that they like to consume.
Devon, how's media viewed within your walls at Akre, and the use of it, and how it's utilized or not, depending on the situation?
Extremely useful, and particularly, and this does precede me, but it was one of the things I really wanted to understand when I came to join the organization was what the launch looked like from an optics perspective. We did hire a firm, SunStar actually, helped us with the launch. So they are also partly to thank for a successful launch, particularly in the case of us where, we're essentially, manager leaves and starts his own fund. That can be good spin or bad. You'd prefer good, so you need somebody handling that for you. And if you're not familiar with working with a PR firm, it's a ton of work what they do to ultimately deliver you something that is has huge unknown potential in terms of eyeballs and influence. But you've got to be able to take the opportunity quickly. We do not have a studio, but I think that's probably for the best. But in that, thinking about the sort of maturation of an organization, even though we're 30 years old, we were starting over. So at that time, I think one of our best pieces was A Veteran Starts Over. It's some years ago in Barron's. That kind of piece does, more than any advertising could. I think everybody can probably appreciate that. Now, today, or at least for the past 7 years, I think since that piece was so nice and we've had a couple like it, we've really just tried to elevate our other, portfolio manager who's been there for 10 years. 60% of the attribution is due to him. It's important as a multi-generational firm that wishes to be permanent for folks to know that. And there's few vehicles other than the media to elevate him. So it's without question that it's valuable. And trying to manage it yourself, I can just tell you, unless you have somebody that's worked for a top 10 firm and you want to pay them to be on the payroll is a mistake. The nice thing about outsourcing is this is all these folks do. So smaller firms wear a lot of hats. That PR is not something that you'd want folks to double up on unless it's other corporate communications and strategic relations. That's just my opinion. But there's no question it's helpful and necessary.
Any questions at the moment on some of the topics we've hit? I think we do have one.
This is a question for Jennifer and Devon. Yesterday, during Warren's presentation, he talked a lot about competition. For some of us here, we have a lot of competitors that we're dealing with in the marketplace when we're trying to get their attention. Can you just talk a little bit about your main competition? Are you in a situation where you don't have a lot of competitors in that space, so therefore that makes it easier to attract interest? Or are there a lot of broader factors that come into play when you're out there talking to people?
Do you want to start? You want me to start?
Yeah, go ahead.
Sure. Okay. So for Tortoise, it's been a bit of a journey. Again, starting with something so specific as MLPs, I think we had very specific competitors. And again, I mentioned this earlier, but we really chose to be a differentiator. So while we had them, we always had a really good story about why we were a little bit different. But we've really evolved where we're not just an energy firm anymore. We're more of an essential assets firm, and our more recent products have been in social infrastructure, so education, senior living facilities, things like that are very unrelated to what we had done in the past. So now we're seen as more of a multi-strategy type firm. So that's really broadened our competitive landscape. So when we look at those multi-strategy type type products, I think it's really tough to see who our competitors are, because you're almost looking at the really big shops like a PIMCO or somebody like that, which we're clearly not, so that it's almost unfair to try to look at them as our competitors. However, what's been really interesting is in this social infrastructure space that I was just talking about, we really don't see a lot of competitors there, and that's really more on the direct and private side, which I alluded to this earlier is why we decided to launch an interval fund. As you've seen, just a proliferation of interval funds over the past couple of years. For this reason, I think having access to direct type of investments, which is not a new thing for Tortoise, we've done that on the energy side, but new in a wrapper that's available to retail investors. We also have private funds that have these types of assets in it, but obviously that's a much smaller segment for a client base. So we've really, as we've expanded out into different asset classes, our competition has just changed a lot. But we really try to do things differently and in our minds a little bit better. So when we do talk about how we stand out from our competition, it's usually on a structure basis or an access to different types of products.
I just assumed that everyone was a competitor at the outset, kind of made it not easier, but a little bit more realistic. When in my previous firms, it was very normal to go, front and center and deliberately pitch against another fund, if not to bring it down a notch, but to suggest sort of the split ticket, how about you split 50-50? That amongst other tactics, which are classic top 25 distribution sales team tactics. I sort of discussed with Chuck, and he's like, no, I don't want to do any of that. We're not trying to behave as if we're superior to other folks. We want the results to do well. We just want, the opportunity for somebody to hear us out. And I thought, okay, said every portfolio manager ever. But the point is, at the outset, it was made clear that he did not want us bringing up other firms' names. That said, it becomes challenging to know. One thing that was significant was from the launch of the fund we had always been considered mid-cap growth by Morningstar. We didn't necessarily see it that way, but if you've got 5 stars, you want it on your fact sheet, it is helpful. So you go along with that. And then Morningstar changed our category to large growth in January of 2017. And we proceeded to have, of course, that came right after rolling onto one of the worst quarters and off of some of our best. So for the first time in the history of the fund, rolling periods look bad, and against a brand new peer group, which is fun. And outflows started almost immediately. So our typical run rate was, numbers probably are important, but we ended up having net negative $200 million in flows for the year, and we ended up having one of our best performance years. I mentioned that because performance is obviously a key component to everything that we do. I mean, folks want results. It's not the only thing, and if you live and die by it, you're gonna see that change in your AUM base. So it really does come down to process, and that's where it becomes challenging to understand who really is a competitor. Can you really get in the minds of other teams? So what you try to derive from that, again, as I do with sales, is just sometimes talking about focusing on what we do and emphasizing what we don't do. Not to demonize anybody else's approach, but simply to try to make it a little more clear how we're different. And I think that really is what it comes down to, is it's still, no matter how many competitors you have, self-directed investors, not so much, but certainly the RIA and advisory communities, they're going to have to relay these stories, the stories behind the numbers, and that's ultimately what they're buying into. So trying to figure that out before proceeding, I think, is very helpful.
Any other questions? If I have a slight digression. Jen uttered the word interval funds, and I can't let that go without talking about it a little bit. So if you don't want to hear interval funds, ask your question. I'm gonna
Oh, they're so exciting.
There, and I'm serious when I say this. I can't go a week without a prospect or someone in the industry calling to talk to us about interval funds. There's about 70 or so that are active in raising assets, and they are attractive. It's an attractive asset class, but there's a mystery that some just don't want to own up to. Is operationally they're very difficult to trade. So the platforms, most of them hate these products. And again, it has nothing to do with the asset class. It's all about the operations and handling that tender, that schedule. The way trading, and I don't want to turn this into an NSCC discussion, but mutual funds are either open or they're closed. There's hard closes and there's soft closes. The platforms are meant to function with those kinds of CUSIPs. The interval fund does not operate that way. The interval fund takes in money all the time with some rare exceptions, but then the redemption period is controlled by the manager. And the platforms are not built to have a person stand there and monitor when products can redeem. And so the hurdles to come into these platforms are enormous. Tortoise has had some success.
It's challenging.
In certain of the channels, and some of the other clients that we have also had some success. Wirehouses, by and large, hate these more than the supermarkets. So good luck to you if you do come to market. So it's just a cautionary message, but they are very attractive. There's a lot of interest around them, and that's the end of the interval fund pitch. Other challenges, and I bring this up, the RFI topic. We observe this again from the distance. Our clients receive either some, none, or a lot of these requests for information from platforms, advisors, et cetera. And we also observe, and again, this is anecdotal, some train wreck processes within our clients. They're not ready, they're late, there's mistakes, there's errors. This has to be managed, is sort of the short conclusion. How does Tortoise approach those, just given the amount of product that you have and the target markets that are relatively large?
Yeah, we actually have a team dedicated to this process because it is so important to Tortoise. And they actually don't live in the marketing team, they live in the client relations team, which I think is also really important. We really are very coordinated in our messaging, of course, but we kind of, I think a lot of our messaging starts with that SMA business, so it comes in more from the RFP and that side of the business, and then we kind of expand that out to more of the platform area. So it's a very well coordinated effort. I mean, we have a database that every single answer to any question you could ever possibly be asked, I think, is in there. Now, where it becomes really tricky for us is that we're evolving so quickly, and we're acquiring firms, we're changing our brand, we're doing things a little bit differently. So the flow of changing those answers to get through to, I mean, I don't know the numbers, but I would say we must respond to, almost dozens a month, I would say, on all of the different platforms and all the different products and the different investor bases. So it's a highly coordinated effort that is amazingly important. And then when you're talking about the platforms, you really, there might be a couple year time span that you're doing something on a platform level, and if it's not, it really needs to sync. So it's all about having one team own it, I think, and not having everybody go off and kind of do their own RFI and have missed messages.
Devon, is it your job a little easier with one product or no less?
Well, unfortunately, it is one product because it's all the RFIs, right, or DDQs. They're sort of interchangeable depending on the types of organizations. The platform level RFIs and ongoing things don't seem to be as frequent. They're certainly not quarterly, whereas those that are and they're frequently in pairs, so there'll be an operational one trying to understand, back to that, do you have a roof or are you renting when we show up type of thing. They want to understand that, the firm structure, the ownership, how that's changing. Comes down to the firm stability. For a boutique firm, that's even more important. And then, of course, the investment side. So we, on a quarterly basis, I populate maybe 40 or 50. Some of them are brutal. One in particular, I won't name the firm, but it was 30 tabs, over 300 rows of information each tab. Now that's something, fortunately, when they had a habit of recreating, the whole grid every time. I'm like, if you kept it the same, we could just bring everything over because almost nothing had changed. They're like, oh, we can't do that. Thank you. So I do recommend hiring somebody for that. But they need to be in touch with the sales, whoever the sales manager or salesperson in my case, because as uncomfortable it is, there's no better finger on the pulse as to what they're looking for, what they're concerned about, whatever issues are, particularly when DOL is such a huge topic. They want to fully understand expense ratio breakdowns, how it got to be there, what the history was, can they expect for their discounts, all those things. So, but on the marketing perspective, I also think in terms of RFIs, in terms of foundations and endowments, and not that that's necessarily the question you're asking, but one thing I would definitely say is, that comes back to know your product line. If you want to be big in the retirement space and you've got a multi-cap product, you got your work cut out for you. Most of those folks don't want a multi-cap product. They don't want the liability of somebody saying, I didn't know what I was owning and I lost capital as a result, I'm going to sue you. So if you're large growth, you better be large growth and then go ahead and proceed. It's still an uphill battle. Same thing with foundations. Anything with a committee attached to it, you can work really, really hard to get to the 5-yard line and then things can change. So RFIs are a part of that, and understanding whether or not you're willing to commit to the time for that from a marketing perspective is important too.
Catherine.
Can you tell us about your direct outreach to advisors?
Direct outreach to advisors.
Like, what kind of marketing material you send them? What about emails?
Yeah.
You talked about your podcast.
Mm-hmm.
What-
It really depends on the advisor that we're reaching out to. And I know I mentioned this earlier, but for the wirehouse firms, you really can't do any sort of mass emailing, so that's a completely different animal. But for the RIA community, we do that. But we really try not to saturate too much as well. We have on our team an editorial calendar, if you will, of what is going out, because I do think it's really important that you make good use of people's time. And now that we've expanded across different asset classes, we really make a distinction of what you're signing up for, so that if you've signed up for our energy podcasts or insights, that we're not automatically sending you something now on social infrastructure, because the last thing we want is somebody to tune out because we've sent them too much or something that they're not interested in. So that's one way, but a lot are on our website. And we do try to drive people to our website as much as possible. And then most of it is really just working with the sales team for their hand-to-hand meetings. And again, I think it's taken a really long time and a lot of writing and a lot of distributing content, but now we actually see people coming to us more for content, and we don't have to push it out quite as much. Obviously we still do that, but it's really funny when we send out our certain podcasts on certain days, and if it's delayed, we will get people calling us asking if they missed it, which is pretty nice.
Will, you had a question?
Yeah, I'm just curious, what trends are you seeing with the RIA community? So, Devon, you mentioned how they're kind of tuning out. So, what is happening there? Are they shifting to passive, from a small active management firm standpoint? What are you seeing in the RIA community right now with asset allocation, things like that?
That's a conversation you and I have had many times, so this is a unique way to answer it this time. How are you? So it's tough to tell. I try not to make assumptions, just observations, right? The reality of it is it takes more touches than ever to get a meeting, and our performance is very strong. So from a sales perspective, there's no excuse, other than the fact that there is a ton of white noise. And so how do you labor to not be a part of it? I mean, this might sound very basic, and I assure you it is, but the tactic is as follows. I send a very short and compliance-approved email with a fact sheet attached to it. I send it to them about 3 weeks out. I'm going to go to Austin, send it to them about 3 weeks out. I hear nothing. I'm unsurprised. About a week later, I call them. They do not pick up. I'm also unsurprised. I do not pitch them on the phone. I simply make reference to the fact I'm going to be in town. Following date, if they type in AKRE in their search box for their Outlook, they'll see our fact sheet. If they're interested in a concentrated approach, I think it'd be of value, and that's it. So they don't respond to the email. They don't respond to the voicemail. But the voicemail, pointing them to the email, sometimes they respond. And the hit rate's about 1 in 10. So that kind of narrows it down. Obviously, we're talking outside of dealing, going with existing prospects or clients. So the hit rate changes based on any number of things. It used to be 1 in 10, then it was 1 in 6, and now it's about 1 in 25. So it's interesting, for the longest time, everyone would take meetings and nobody would allocate. And now nobody wants to meet, everybody wants a call, and they're allocating. I will take it. My kids are like, what are you still doing here? You're usually not here. I had to actually leave, and my 2.5-year-old said, Dad, you've been around for 2 months. And I'm like, you've been talking to Mom. So, point being is, it's always in flux, is the answer. So the ironic thing is even though we crossed 10 billion, and that's wonderful, it won't always be that way. Performance won't always be strong. And our fund's really largely been built by self-directed investors that are frankly willing to pay a little more because we're not the cheapest in town. And I don't think we ever will be because we're not, going to grow more product. That's not our proficiency. Tortoise has made an enormously successful reputation on delivering what people are really looking for rather than just cramming products. So that's a unique approach. We're not that smart. We're just trying to do one thing and find like-minded investors. So with the RIAs, it comes down to I'm still looking for the same sort of, shops that help us build the fund, those smaller shops that at the end of the day, to quote my founder, he said, listen, if we give them good outcomes, we literally help them grow their business. Think how powerful that is. So that's kind of neat. So trying to approach things from that spirit helps, but frankly, it's still uphill.
What about your direct investors? What do you do to attract them? And what percentage do you have?
About 35%. And when I say direct, I just mean anyone who has chosen to buy us rather than, we're available in a 401k, and we have less than 1% ERISA money, so it's very, very little. Speaking of, plans, not IRAs. We don't do much of anything to attract them, except focus on the portfolio. Now, this sort of gets into client communications. We're very low turnover. We don't have capital markets opinions. If we did, we wouldn't talk about them anyway. So that means a quarterly call is sort of too much. So we do a semi-annual call. Ours is this afternoon at 4. And so that's an open call to anyone who wants to call in, and knock on wood, everyone's behaved so far. But it's become increasingly well attended. And what we really want to do, we've just recently revamped it this past fall because it really got into just 90% Q&A, and that's great. You want to answer questions, but folks really want to hear what you think. And most importantly, if you're concentrated, you have high conviction. If there's any concerns about a potential name, folks either need their question answered, need that unpacked for them, or if you're an advisor, they need the talking points to relay to their clients. Our clients have clients, right? So we've just built the entire call around trying to provide that level of depth. One case study per call, so we'll go pretty deep on a name, and then frequently asked questions, which tends to be a catch-all. We encourage pre-submitted questions. I'd say half of them are self-directed investors, so the model seems to work. There are hundreds and hundreds of people on the call. And then if we have time, we open it up and for questions. I think that's one of the most important parts because back to access, you're showing that between your demeanor and the content and your being prepared, you're showing folks that you treat it still like it's $100 million and not 10 billion. So.
Can I just ask a quick follow-up to that? How do you deal with the compliance aspect, particularly given that you've got a lot of individual investors falling in as well as institutions?
So it changes, as you might be aware. A live call, it's a marketing event. It's when you want to make it a replay that it becomes a real compliance event, which is where about 50% of my gray hairs have come from. Because I like, please don't say that. Like on the, we do these dry runs, I'm like, you can say that, Chuck, and I know it's true, but it'll never make it through compliance. Can we choose another way? So that's come a long way in just saying, and we're not talking promissory, but anything that could be construed as promissory will be problematic. We like to have our replays for 6 months because we are so low turnover and we're not talking about, recent historic events. So they don't go stale, and it provides wonderful scale for those that are interested in what we do. About 3 times as many people listen to the replay as are on live. So it's very useful for me, particularly if I'm dealing with an institution and I don't want to make the whole team available to, let's face it, an investor that may not want to move to the next level. do I want to book my whole team for an hour call, or can I just, tactfully suggest to listen to this call? And folks take us up on it all the time. So it seems to be very, very helpful. So it's not, we're not doing blogs, and we're not on Twitter. At least I hope we're not. I'm not aware that we are. But I think that's another thing that's very important is when investors, of all kinds know what they can expect from you, it's so much easier. I kind of liken it to if you go to a restaurant and nobody comes to greet you, you get impatient quickly. If they come and take your drink order, you're okay. You can wait a little bit because you know that they know you're there. It's the same situation. If somebody knows that they can submit a question and get it answered, not necessarily 6 months, but on a regular basis, we have our fact sheet commentary, we have a pitch book, we also have a generic DDQ now for institutional investors, as well as a document that, in lieu of attribution, provides all those sort of things. So just pick those things, make them quality, stick to them, make them timely, and be consistent, I think.
I have one quick thing to add to that, because as I mentioned, now that we do our kind of weekly podcasts, there has been talk about, do we really need this quarterly call anymore? And we really only do it for the Q&A, which is interesting, because we do feel like that would be a miss with our investors, because we give them so much content on a weekly and monthly basis. But if we need to have that access for them to actually ask us questions. And how we deal with that on a compliance perspective is we repost the call, but we do not include the Q&A. And that's kind of the motivation of actually being on the call. If you have a question and you want to hear others' questions, then you have to be on a live call. So that's how we've dealt with it.
Punishment.
Well, we can't control the question or the answer, so that's just been our practice. And that's the motivation for being on the call.
Any other questions? Devon, one thing I wanted to ask, the rapid pace of growth, how's that been a challenge? The good problem to have, obviously, but
It's been pretty steady. We eclipsed $1 billion in June of 12, and then at that point, that's a scale where you can actually start to take on some more meaningful sizes, and then performance has been strong. So that sort of flywheel of growth hasn't been too hot. Since we're already talking the numbers, the sort of average flows for a year are about $500 million, sometimes a little more, sometimes less. And as I mentioned, 2017, it was net outflows of 200, and then for almost all of last year, it was net positive 200. So it was flat for 2 years, following one of the best performances we'd had for a calendar year. Flows have ticked up markedly since December. So I think the key here is, I spoke with the wirehouses. We have a lot of those investors. We also have a lot of independent broker-dealers, more than ever. So I think the way I respond to that is inquiries I respond to like right away, like within an hour, no matter where I am. I have not put my phone down for more or less 7 years. And the reason is I don't want somebody else giving them the message. I'm trying to foster that relationship. It's heavy contact at first, and then once they know what they can expect, they tend to relax, and that's exactly what we want. So it's not efficient. It is in terms of head count, not in terms of my lifestyle. But we found that it's a genuine approach, and folks really appreciate hearing back right away when they've got 25 million with, I'll just say, a big name, and they've got to wait most of the day because that individual's busy in meetings, and I am too. But I think any way we can differentiate ourselves, and that's definitely one of them. So with a small shop, if you start adding head count, that comes back to how you want to grow. We're going to just grow by head count, and then hope that hopefully these folks can replicate our culture. That's a tall order. So we're very protective of our small shop, and so.
I'm going to have to charge you for that slow and steady comment. That's kind of our tagline: steady wins, registered.
With the
with
tortoise. I got that.
Tortoise. Yes, Catherine.
Quick question, because we're out of time. Do you select particular regions to work in?
I certainly prefer east of the Mississippi for selfish reasons. No, although I will say the West Coast is pretty much once, maybe twice a year, and it's just an onslaught because you're flying that far, so let's make the most of it. And it's a tough market. As most of you are aware, it used to be New York, specifically Manhattan, Chicago, various parts of California and the Pacific Northwest are some of the biggest financial epicenters in the country. That remains true, but you also have a lot of capital that's domiciled right there. You have Silicon Valley, you obviously have Wall Street, and so that changes the cultures there. There's a lot of folks that, not to mention, there's money there and everyone's selling to them, so that white noise is at a fever pitch. But one of the things that's been interesting, regardless of politics, and no, I'm not going there, is there's been a huge movement of capital to the south, from Texas all the way to the eastern seaboard. If you haven't been to Tennessee or to Texas recently, it is unbelievable how much capital shows up. There are 200 new households showing up every week in North Carolina. Nashville has 100 families a day moving there right now. So what's interesting is, and the folks I'm meeting, there are a lot of transplants. So the money that said no to me in New York is saying, we'll talk in Tennessee. It's a very interesting time. So as a result, that's not my 100% justification for staying in the South, but that's one of the reasons why it deserves so much attention. You can't overlook anything. It's just a question of whatever's working. You want the conversation, so.
Great. There is a question. Are we going to tolerate it? We will.
It's such a legal word, tolerate.
Just a quick follow-up for Devon on that. You cover the whole country. Why have you chosen not to add wholesalers in other parts of the country?
So I enjoy the torture, I think. Part of it has to do with, because we are a small shop, it comes down to incentives, right? So our portfolio managers aren't incentivized by how many wins they have in the portfolio. Chuck said and was adamant, like, I don't want an eat what you kill culture here, so sales is the same way. So even though we've had huge growth, I'm unlike a lot of wholesalers, I'm not paid basis points, and there's benefits to that. There will be when there's a downturn, hopefully. But as a result, there's a large component of the sales world that's frankly driven by fear, just to be candid with you, and that's part of the package. Folks are adults, they're working hard, men and women spending a lot of time away from their families, knowingly doing so. But you sort of built with that personality. You have it or you don't. Basically, the lack of intelligence to realize that you're having Groundhog Day every single day. I'm only speaking to myself. So that's the main reason. And I think the other thing is, for what we do from our investment standpoint, since we're not going to be launching additional product, and we also believe that at some point AUM is the enemy of performance and outcomes really matter. I mean, they really matter to us. So we don't know when we'll close. We're not even talking about it now, but at some point it will happen. So if we've managed to be successful enough to get where we are, we don't anticipate our needs really changing, but we talk about it from time to time. They offered an assistant, and I basically just have worked very hard to foster these relationships and contacts, and I feel like it's worked well. But any way we can serve our shareholders better is a top priority. It doesn't necessarily mean headcount, but it could.